And if we do have any technical issues, just let me know. Okay, thanks, John. Appreciate it. All right, so today we're going to be talking about the American Rescue Plan Act. And this was signed into law, I believe, March 11th. It's the third, or I should say, second COVID relief bill, third round of stimulus checks. And so we're going to look inside of this bill today and talk about, obviously, the big headline, which is stimulus checks, but also all the other things that are included in this bill. And again, every time they put out a new bill like this, the naming always makes me giggle a little bit, because it's always, the American Rescue Plan. It's like you can't be mad at a rescue plan for America, but and the CARES Act, for instance. So they're always great at naming bills, so you can't argue with them. So anyways, right off the bat, we talk a lot about in this group about the value of a good plan for your retirement. At the end of the day, our slogan is kind of, you don't need more money, you need a better plan. And with a better plan typically comes a better advisor as well. And so this is a perfect instance where I think the value of a good advisor, a value of a good retirement planner is really shown through, because in the past year, we've seen some significant sweeping changes from the CARES Act and the American Rescue Plan Act. And for a lot of people, this should change your retirement plan. Okay, we're going to be talking about one thing in this presentation today around healthcare, where we're changing a lot of healthcare plans for clients that are retiring prior to 65 and are going to be on Obamacare. Okay, and so with all of these changes, is your retirement plan changing accordingly? Okay, because it should be in a lot of cases. And so hopefully that's clear as we go through this presentation. I'm just going to try to move my head over here. So what's all inside of this American Rescue Plan? Okay, the first kind of big headline, again, we all know about, is the stimulus checks. But this is another $1.9 trillion bill. Okay, and if we see over here on the right, stimulus checks are just 410 billion of this 1.9 trillion. So there's a lot of other things that are included in this rescue plan. The big things that we're going to be talking about today are healthcare changes. They changed the tax filing date. Now, this wasn't technically part of the American Rescue Plan or Plan Act, but it came shortly after, kind of corresponding to this. So they moved it back, the tax filing date, and then so there were some unemployment enhances as well. We're going to talk about each of these as we go through this presentation. I will say this presentation is going to be a little bit shorter than usual, but hopefully just as impactful as usual. So again, first big thing are stimulus checks. And this stimulus check was the biggest of the three. They sent out $1,400 per taxpayer and also dependent. Okay, so if you're married, you stood to earn, I guess, $2,800 from stimulus checks. If you had some dependents, a little bit more, $1,400 for each dependent as well. Now, there were some, might be having a technical issue. One second. Sorry about that. Just making sure my internet just didn't cut out. Okay, it looks like I'm still going. Sorry about that, guys. The one thing that did change with stimulus checks this time, they had a cutoff that shifted from past stimulus checks. Okay, so I believe the past stimulus checks went from, for a married filer, went from 150,000 to, I believe, 175. They cut that off much sooner at 160 this time. Okay, so this created a cutoff where people that might have gotten previous stimulus checks didn't get these stimulus checks. So for a single filer, and again, this is based off AGI. So what AGI is, when you take your essentially all of your taxable income before the standard deduction. Okay, after the standard deduction, it's referred to as taxable income. Before the standard deduction, it's referred to as AGI. Okay, so this cutoff is based off AGI. So basically, before the standard deduction, if you were married, or let's say you're a single filer first. If you're a single filer and you had less than $75,000 of AGI, you got the full stimulus check in full. It phased out over the next $5,000. After $80,000, you didn't get anything. For a married filer, same thing, less than $150,000, you got the full stimulus check. phased out from 150 to 160. And then after 160, you don't get any stimulus check. And so this creates a little bit of a cliff where, if you had an extra, if you were working and you had an extra bonus or something that pushed you over the limit, you just didn't get any of the stimulus check. Okay, now you may be able to get it going forward into this year. So we'll talk about that in a sec, but it is based off 2019 or 2020 tax returns, whichever one you filed most recently. Okay, and just to kind of look at what this phase out looks like on the screen here, we see that again, for a married filer, that green line in the middle, married filer jointly with no children, they stand to get $2,800. We see at 150,000 of AGI, it starts fading out from there on out. Okay, so there are a couple different checkpoints that if you didn't qualify to get it, let's say that you had filed your 2019, but you haven't filed your 2020 yet. Okay, you still may be able to get that stimulus check if you haven't received it already. Okay, even if you didn't qualify off the 2019 or the 2020 because of, let's say you had big Roth conversions or something like that, you may still be able to get it in 2021. So there are 3 different checkpoints that I just kind of want to quickly walk through for those that didn't receive a stimulus check, but still want to receive a stimulus check. And again, when we're talking about $2,800 as a stimulus check, that's a large sum that it may make sense to switch around your situation, maybe do a smaller Roth conversion this year in order to qualify. So pretty simply, if 2019 or 2020 AGI, this first checkpoint is lower than that lower threshold, you just get the full amount. Okay, pretty simple, pretty self-explanatory. If it was between the lower threshold and the upper threshold, meaning the 150,000 to the 160,000, okay, you get a pro rata amount. Okay, basically that amount in between. Checkpoint 2 would be basically filing before this additional payment determination date. Okay, so if you haven't filed your 2020 yet, you can file basically before this additional payment determination date, which is August 17th, 2021. And for business owners, they can file as late as October. So if you're a business owner, it might make sense to file before that October 15th date in order to receive the stimulus check. But basically, same thing for checkpoint 2. If your 2020 basically qualifies, you get that full amount rebate. Checkpoint 3 is the interesting one for those that didn't know. Obviously, nobody knew that the third stimulus check was for sure coming. So if, let's say, you did higher Roth conversions or something in 2019 and 2020, therefore you don't qualify for that stimulus check, you can actually still qualify off your 2021 AGI as well. So it creates a situation where you're not going to receive the stimulus check this year, but you can operate your situation in a way where you receive it at tax filing for next year. Okay, so this is important. You can essentially qualify off potentially 3 different years. Okay, and so even if you didn't receive it yet, try to plan for it in the future. For most people, it's going to make sense to manage your situation in a way that you can still receive that stimulus check. Okay, one thing that might not apply as much to people in this group, but I'm sure will apply to, if you have a child that has grandchildren, that has grandchildren, it may apply to them. There were some child tax credit changes. Okay, so the big thing was that it was changed to a refundable credit. Okay, so in the past, child tax credits were non-refundable. Basically what that means is, let's say a child tax credit, let's say you had 3 kids, $2,000 in the past for each kid, and let's say you only owed $5,000 in taxes. Okay, so that child tax credit would wipe out. You'd have a $6,000 child tax credit. You only owe $5,000 in taxes, so you'd essentially have an extra $1,000 credit that you're not using. Okay, in the past, this was not refundable. Now it is refundable. Okay, so that's a big deal. For somebody that doesn't pay as much in taxes, that has a few kids, you can actually receive money back from the government. Okay, so you can wipe out your tax obligation and still receive money back, which is pretty interesting. Amounts were changed based on age. For those that have children less than 6 years old, the tax credit was raised to $3,600. For those over 6 years old, it was raised to $3,000. And just know, again, this phases out once again based on those same AGI numbers that we talked about before. For somebody married filing jointly, for every $1,000 that they have over 150,000, this child credit phases out by $50 for every $1,000 over. So again, if you have children that may qualify, once again, it may make sense for them to potentially even forego a bonus at the end of the year in order to stay under that $150,000 mark to receive stimulus checks for each of their children, as well as themselves, but also to receive the full tax credit as well. So it creates an interesting situation where some people are actually going to be better off keeping their income low. So again, I know it's not going to apply to most people in this group, but it may be a discussion that you want to have with a child or a grown child that you might have. Okay, so let's get into the real meat and potatoes, where I think the biggest change that isn't talked enough about comes from with this American Rescue Plan, and that would be around healthcare. Okay, so the big change, it's the simplest of the changes for healthcare. Healthcare for those that were terminated from work. And basically what it does, if you were involuntarily terminated from work, the American Rescue Plan creates a situation where from April through September of 2021, you can maintain your existing healthcare through COBRA at a cost of $0. Okay, and this is something that might apply to a few people in this group, because a lot of times we're seeing, through all the trouble that some of these companies have been put through because of COVID, because of all this shutdown, we're seeing a lot of people that were on the edge of retirement essentially getting kind of an early retirement, if you will, and involuntarily being terminated because, again, those are typically the most experienced people. They're the highest paid. And so when you're looking at cost cutting, we're seeing a lot of people on the edge of retirement essentially getting terminated early. Okay, so if you fit into this category where you were terminated early, you may be able to receive the same health insurance at no cost, essentially from April to September. Okay, which is pretty interesting. Another change, which will apply to a lot more people in this group, are changes around the Affordable Care Act. Okay, and so let's say that you retire prior to 65. Okay, so you have to health insurance has to come from somewhere. Okay, there are typically two options that you have. You can take some kind of continuation from work. Now, typically that ends up being a little bit more expensive because while you were working, your work subsidized your healthcare costs. Well, now when you're retired, you might still be able to stay on that same plan, but no longer are you subsidized in most cases. So your health insurance might go from a couple $100 a month, or maybe nothing a month, to $1,000 a month. It can get pretty expensive, and it's a big fear for a lot of people retiring prior to Medicare. The other option, which can often be a lot more cost effective if you plan your situation properly, is to enter into the public marketplace. Okay. And the key thing about entering into the public marketplace is that you have to control your income, because your healthcare premiums are going to be based off your reported income. So again, if you're able to control your income, and we'll talk about how you can do that in a sec, almost always the public marketplace can be much more cost effective. And you can receive a subsidy of something like $1,200 to $1,500 per month. And so on Obamacare, you can create a situation where you're paying couple $100 per month, or as low as $0 per month for healthcare. So how do you qualify for this subsidy? Well, previously, and in most years, you qualify based on your household size and your modified adjusted gross income. And so again, previous rules were that for a household size of 2 people, if you made more than $68,960, or rather reported an income more than $68,960, you didn't receive any subsidy. Okay, and this is based off percentages of the poverty level. So $68,960 is 400% of the federal poverty level. And again, they look at the income in the year that you need ACA. Okay, so basically what this did, again, previous rules were that it created a healthcare cliff. Okay, so basically if you're married and you made more than $68,960, your subsidy fell off again, like a cliff. On one side of the cliff, you might be paying something like $500 a month for healthcare premiums. Okay. And you'd have a reasonably priced deductible for that healthcare insurance. Okay. On the other side of this cliff, you might be paying something like $1,500 a month for healthcare insurance, and you'd have a much higher deductible. Okay. And so controlling your income makes a ton of sense in the previous rules, especially because of this cliff. Well, the new rules basically eliminated this cliff for 2021 and 2022. Okay, so what were these new changes? Well, basically, rather than giving a subsidy based on these income levels and therefore creating a cliff, now they control your healthcare premiums in accordance to your income. Okay, so let's look at the most aggressive part. Let's say you're above that essentially 68,960. Well, now they basically capped your healthcare cost to be only 8.5% of your income. Okay, so basically this creates a zone where you can make much more than 68,960. Okay, because again, you're still going to grow again over 68,960. Your healthcare premiums are still going to go up, but essentially for every dollar that you go over, it's only going to raise your healthcare premiums by, call it 8.5 cents there. Okay, and again, this is in effect for 2021 and 2022. And so this is a huge change. We have quite a few clients that are on, that will be on ACA or are on ACA that we've been controlling their income, which means taking from Roth IRAs, taking from brokerage accounts, okay, in order to keep their income artificially low while still allowing them to take a higher income. Well, now, essentially, you can take a higher income without having to be subject to that healthcare cliff. Now, again, your healthcare premiums are going to rise, but they're going to rise far slower than that cliff would have created. So if we just visually look at this, again, in the previous law, we saw this healthcare, the subsidy cliff. So when we look at healthcare as a percentage of your income, okay, when you essentially went over that healthcare cliff, you saw your healthcare costs rise substantially. Under these new changes, again, for 2021 and 2022, it's going to rise much more linearly. Okay, and so what does this mean? Okay, so if we can just simplify this, what does this mean for your retirement? Well, again, before we might have had a client taking money from Roth IRAs, taking money from taxable accounts, which ideally we don't want because those are the two most tax preference accounts that you have in retirement. So ideally we want a Roth IRA. We don't want to take from a Roth IRA. We want to let it grow. Okay, we don't want to take from a taxable account. We want to let that grow as well. The accounts that we do want to take from are tax deferred accounts because, again, in 2026, the Tax Cuts and Jobs Act is set to expire. RMDs down the road can really throw a wrench in your situation. So what does this mean? Well, basically, you're allowed to take higher income from tax deferred accounts. You don't have to be controlling your income in the same fashion because there's not that healthcare cliff anymore. In some situations, it might even open up the doors for a Roth conversion. Previously, again, Roth conversions weren't really possible because the last thing that we want to do is do a Roth conversion that puts you on the other side of that healthcare cliff and causes you to owe an extra $1,000 a month for healthcare costs. Well, now we can calculate out a Roth conversion. And again, a Roth conversion will still raise your healthcare costs, but it's going to be far more minimized than it was previously. And tax gain harvesting on taxable accounts. So what is tax gain harvesting? Well, for a married couple, if you have an AGI less than $80,000, you can essentially take long-term capital gains and pay 0%. Well, it creates a situation where you can tax gain harvest and not have to worry about that healthcare cliff. And so again, this is a huge change for those that are retiring before 65 and entering into ACA, and therefore your plan should change. For a bunch of our clients, it means we're probably going to be taking money from tax deferred accounts in order to fill some of that income. So the fourth thing in this bill were for those that received unemployment in 2020. And basically they created, normally unemployment is taxed. And basically what they did is they created a portion of this bill that allowed for $10,200 of unemployment in 2020 to be tax-free. Okay, again, this does come with phase outs based on AGI. For those making less than 150,000, it starts to fade out. Now, interestingly enough, this is applied uniformly to filing status. So the 150,000 is the same for a single filer. It's the same for a married filer. And 150,000 in this case is a true cliff. You make 150,000 and $1, and you no longer get that tax-free unemployment benefit. In the case of joint filers, it can be up to, you can basically double it. It can be up to 20,400. So again, you have that same uniform filing status, but you get essentially double the benefit if both of you ended up being on unemployment. And again, this is something that we've seen a lot more of in the past, is essentially companies have been moving some of these older workers on the edge of retirement and essentially forcing them to retire early. And again, the other thing that's important to note is the AGI is actually, AGI typically stands for adjusted gross income. MAGI, you'll see often used, it stands for modified adjusted gross income. And so they're actually basing this off modified adjusted gross income to exclude unemployment. So let's say that you had $160,000 of AGI, but you received $10,000 of unemployment. Well, you would actually have a modified AGI of 150,000, and therefore you would be able to qualify. Okay, so there are a lot of things talked about that weren't included in this bill. One of those was an RMD relief. They were talking about foregoing RMDs for this year. That's not the case anymore. You still have to take your RMD. One thing that was talked about that I think most people missed, they were talking about eliminating cost of living adjustments for retirement plan contributions. Okay, so each year, essentially, they adjust the contribution limits for IRAs, for Roth IRAs, for 401ks in accordance to inflation. Well, they've been talking lately about eliminating this cost of living adjustment. Essentially, it's a stealth tax in a way where they're trying to cause Americans to shelter less of their income in these retirement accounts. So they're talking about eliminating that. Thankfully, it was not included in this bill, but it doesn't mean it's not going to come back in the discussion. No minimum wage hikes, and then no complete student loan forgiveness. Again, both of those were talked quite a bit about. I don't know what aisle you fall on, but those were not included in this as well. Here's one thing that's important that I think we've touched on in the past, but important to just reiterate again. This is the second $1.9 trillion bill that we've sent out. This is the third stimulus check that we've sent out. We've added a lot of debt in the last year. If you see any debt charts coming out lately, it's basically like a hockey stick graph where we've been adding a ton of debt relative to the past in this last year. And for a lot of retirees, and deservedly so, are worrying about inflation. Again, when you send out all of this money, all of this essentially free money to people, we've seen a lot of different costs go up because of it. Because again, stimulus checks went out, and I don't know if you drove past the mall, but it was completely full after stimulus checks went out. And so inflation is a big concern for a lot of people going forward in the future with all this money printing and whatnot. Well, we're starting to slowly see it come through. We'll see if the trend continues, but last month was the highest inflation that we've seen in the last 10 years. Okay. As you can see, inflation was a little bit over 0.6% last month. Again, we'll see if this continues as we're adding so much debt. Over the long term, I think it has to continue in some form or fashion. But my point here is there are unintended consequences to these bills. A big one is inflation. And for retirees that are investing, you need to be thinking about inflation top of mind, because this is something that's going to show up each and every year. It's not going to feel like it makes a huge difference in one given year, but slowly over time, it will erode your wealth. It'll force you to take income raises in retirement. And so make sure you're thinking about that as you're investing. Okay, if you're investing in a CD at 1%, okay, inflation last month alone was 0.6%. So you had a huge part of that return on that CD eroded last month. And so it's forcing retirees to invest with inflation in mind. Okay, focus on the real return meaning inflation adjusted return. Okay, and so again, just kind of a note on the future effects of this bill. So in summary, there were some extremely important changes for retirees in this bill. I think the biggest one centers around healthcare. If you didn't receive your stimulus check this year, manage your situation in a way where you're able to receive it next year. Okay, you can still be eligible in 2021 if again, you meet those same limits. Married filer between 150 and 160. If you're less than 150, you receive it in full. So it might make sense to situate your or position your situation in a way where you can still qualify for that. And then again, question to think about over the next couple of days: did your retirement plan adjust with these changes? Okay, I can tell you behind the scenes, we're adjusting a lot of our clients' retirement plans. And so if your retirement plan isn't adjusting, it may make sense to ask why. Okay, if some of these things apply to you in your situation, you may benefit from a second opinion. And again, always remember, you don't need more money. You need a better plan. I'm not seeing too many questions come through, but feel free to shoot them in here even afterwards, and I'll try to answer as many as I can. And one thing that I want to point out too, when we say you don't need more money, you need a better plan. A better plan isn't a one-time thing. Okay, a better plan, or a well-built plan is adjusted each and every year. It's adjusted with the American Rescue Plan. It's adjusted with the CARES Act. You know, as we see tax changes in the future, plans adjust. And so a retirement plan isn't a one-time thing. It's a continual, ongoing thing that needs to adjust. Okay, so hopefully this was informational. Hopefully this gave you guys a little bit more insight into this American Rescue Plan. We covered what I think are the four biggest things that might apply to you in your situation. Hopefully it was educational. Again, leave any questions that you have in the comments. Thanks for watching, and we'll see you again next week. Thanks, guys.